Okay, good morning.
Morning.
Okay, welcome to our class. Someone is asking about the link to our second class. Okay, so we had agreed that we're going to start off with a new topic. It's a very short topic, by the way. But essentially, it's like sort of concerning the financing decision. If you remember, we were discussing the three core financial manual decision. We discussed on the investment decision, we discussed on the financing decision, and we discussed on the dividend decision. So we did mention all these decisions. But when it comes to financing decision, we did say that you may have to consider where the money will come from. Okay, and generally, we normally say that the company can obtain money from two main sources. Okay, let me share my writing area. So the two main finance sources the company can use: either the company can obtain financing from what we call the financial market. So this is source of finance. They can obtain either from the financial market or from the financial institution. Okay, those are the two main, let me call them financials, okay, or financial market, sorry. The two main finance sources the company can obtain its financing from, either from the financial market or from the financial institution. So the key, we want to know what's the difference, what constitute, or what constitutes financial market and what constitutes financial institutions. Okay, now let me go back to the basic economics of finance. Okay, where you see that in the economy we are going to be having like, let's say, two units. Okay, we'll call the surplus units. Like, those are people within the economy who have more money than what they need. Okay, and you have what we'll call the deficit units. Okay, the deficit units. Okay, these are again people within the economy whose need for capital is they have more need for capital than what they are able to individually generate for their own operations. Okay, which means therefore they have more. The need for capital is more than what they're able to generate. Okay, therefore they are more like the borrowers. Okay, so therefore this we call them, for example, savers in the economy, and these are what we will be referring to as the borrowers. Okay. If the deficit units in the economy, companies, for example, okay, they are going to contact the surplus unit directly, okay, in order to obtain the financing, okay, in order to obtain the financing, then we say, in short, for example, if the deficit unit is going to go to the surplus unit to request for the funds, okay, to request for funds, in short, they'll be offering the surplus unit a contract that is going to be dictating how they will be repaying back the finance. Let me use that term. Okay, so the flow of funds will come from the surplus unit to the deficit unit. This is funds, and here we are going to have a contract. Okay, that is going to dictate the terms and conditions of the financial transaction that has just happened. Okay, what we'll be referring to as the financial assets. Okay, so the contract is more as like a financial asset, or what we call a security. Okay, so if that's how the target will be, like that, you're going to have the surplus unit, you're going to be having the deficit units going straight to the surplus units, okay, within the economy, to the savers, okay, to obtain the money. Then you're going to say the transaction is occurring in the financial market. So this transaction is occurring in the financial market, okay, in the financial market. Okay, we'll be having the surplus units invoicing directly to the deficit units. Okay, that we normally say the transaction is occurring in the financial market section of the market for funds. Okay, you can have cases where, okay, it's quite hard that you can have the deficit units getting to know who is having excess money. Okay, so sometimes they have cases where you're going to have companies that do come and form themselves in order to act as an interlinkage between the surplus units and the deficit units. Okay, so here you can have a company, okay, for example, bank, okay, let's say this what we call, for example, a bank, okay, that is going to act as intermediary between these two institutions, okay, the surplus unit and the deficit units, okay. So you can have, for example, the savers or the surplus unit, they come and save their money to the bank, so this is saving, okay, and you're going to have the bank lending the money to the deficit units, okay, so they're going to obtain, so the flow of funds, so this goes to the deficit units through borrowings, okay, so through what we call the bank lending money, okay. So that's what the flow of funds will be like, okay? Or the funds will go to the deficit units. However, we do have an intermediary, okay? We do have an institution that is connecting these two parties, okay? So we know if that is what is happening, okay? Of course, you see the transaction is occurring in what we call the financial institution, okay? So this is called, the transaction here is occurring in what referred to as the financial institution. The financial institution, okay. We are here, don't forget the bank is have to give more or less like a promise that every year you're going to pay you an interest, okay. If you save money with us, okay, every year you'll pay you X amount of interest, okay. Of course, the same applies here, okay. You'll be having the debt units, okay, giving or entering the contract with the bank that every year this amount of interest, for example, we shall be paying you, okay. So don't forget here, the bank is acting as an intermediary, okay? And sometimes they're called financial intermediary. They act as an intermediary between the surplus unit and the deficit unit, okay? Financial intermediary, okay? Financial institution, stroke financial intermediary, one the same thing, okay? And that's a key distinction between these two parts, okay? The financial market and the financial institution, okay? Simply, how does the flow of funds occur, okay? Does the flow of funds occur straight from surplus unit to the deficit units, okay? If that's what's happening, okay? Let me give an example, okay? The case of shares, okay? Look at the case of shares, okay? This is one of the financial instruments. Over here is the financial security or assets, okay? Shares, for example, you have, for example, Safaricom going to the market, okay, asking the public, okay, we would want you to buy our shares at this particular price, okay. So this Safaricom, in that context, therefore, is going to be asking the public, those who have surplus money, because you can't buy shares in case you have no surplus money, you must have surplus money, okay. Therefore, the flow of funds will come from those surplus units, those potential investors to Safaricom, okay, straight, direct issues, okay. That transaction, as we mentioned, is occurring in the financial markets, okay? However, in case the Safaricom would go to, let's say, CBA, okay, to borrow money, okay, they're going to be going to the CBA. CBA has, in quote, has no money, okay? It's going to be relying on the amount that have been saved by the bank, by the savers, okay, the surplus unit, okay? So therefore, CBA bank, for in that context, okay, CBA, whatever it is, okay, it will be acting as intermediary, collecting money from the depositors and lending money to the deficit, to the borrowers, okay. So it's acting as an intermediary in that context, okay. That's the key difference between the financial market and the financial institution, okay. I hope it's clear. If not, you let me know, okay. So that's where we can say the finance will come from, okay, from those two main sources, either from financial market or from a financial institution, okay. And I'll give you an example here.
Sir?
Yes.
Could you please explain financial market once more?
Okay, financial market. This is going to be a section, let me call this that way, a section or part of the market for funds, okay, where the transaction, let me give an example, okay. For example, NSE is going to provide that forum, okay. Let's say the Nairobi Security Exchange, okay, the Nairobi Security Exchange, the NSE, gives or provide a forum where the surplus unit, the deficit unit, for example, okay, can come and make an invitation, okay, to the surplus unit in the economy, okay. These are the investors. Hey, we as Safaricom, we want to sell our shares to you, okay. Every share shall go for 20 Kenya shilling, okay. So the surplus in the economy, those who would want to buy the shares of Safaricom, for example, will go to the NSE, okay, the Nairobi Security Exchange, okay, and buy or subscribe the shares of Safaricom that are being offered, okay. Therefore, the flow of funds, okay, as I mentioned, is from the surplus unit straight to the Safaricom account, okay. So there's no intermediary, okay. Once you deposit money through, for example, you buy through the broker, okay, through the principal advisor, okay. okay, because there'll be an advisor who is going to be advising Safaricom, okay. So the banker of Safaricom, so the flow of money is coming from you as a potential shareholder to the banker of Safaricom, okay. So the flow of funds is from surplus unit, the deficit unit, okay. As I mentioned, of course, there'll be a platform to be provided. In this case, in the case of Kenya, for example, it will be the NSE, where those transactions can occur. It's clear on the question?
Yes, thank you.
Okay. So as mentioned, as we wanted to mention, the financial institutions, of course, the key member or the key part of the financial institutions is the banks. Okay, of course, the banks are the merchant bank. Okay, they may qualify them, the so-called merchant bank. Okay, because banks there are very many, by the way. Okay, so enough we know which is which. They have quite many of banks. Okay. But of course, most of the banks, okay, they'll be acting as financial institutions for most of the commercial banks, okay. Then of course, what else do we have? They can act as financial intermediary, circles, to give an example. What else? You know this, there are quite many.
Insurance companies?
Insurance company, thank you. Insurance company, they actually act as intermediaries, okay, insurance company, okay. Pension funds, okay, whether private or public. For example, in the case of Kenya, the case of NSSF, okay, NSSF actually is an intermediary, okay, collects money from the contributors and invests that money. So actually they're acting as an intermediary. What else? What other examples? Mutual funds, okay, mutual funds or associations, they also act as intermediary, okay. Like some example case of the old mutual, which I think you all know, okay. Of course, is acts as an intermediary. You would want to invest through a mutual fund, so go with how much money? Okay, 100,000. Okay, then the mutual fund gives a promise that every year or every 6 months or every 2 months, we shall be giving you an X amount of interest, an X amount of return, not interest, for the amount you have invested in us. Okay, but for the mutual fund, on the other hand, is going to be acting as it will be invest that money, okay, through shares, through T-bills, through treasury bonds, okay. So the mutual fund, as per se, is acting as an intermediary. Okay, you as the investor, the one who has surplus unit, invest in, and this mutual fund invest in the companies that do require the money, okay, through shares or whatever bonds it is, okay. So mutual funds also themselves, they also act as financial institutions, okay. Conventional, okay, the informal chamas we normally have, case of Kenya, the merry-go-round, all those, again, they act as financial intermediary, okay, of course, in an informal context, but they're still financial intermediaries, okay. We can also have the case of the venture capital firms, the venture capital firm, okay, where now we have venture capitalists who do for example, a venture capital firm, okay, and they will be investing in, for example, startup company, small, new company that have huge potential, okay. So also this case, therefore, venture capital firms therefore can also act as an intermediary because they'll be collecting money. The firms themselves will be collecting money from the venture capitalists, okay, and invest that money to the small firms that don't require money. So the venture capital firms, okay, not the individuals, okay, are acting therefore as intermediary, okay. That's the case of the financial institutions, okay. In the case of the financial market, okay, we can further, okay, subdivide it into two, okay. We have what we call the capital market, and we have what referred to as the money market. Okay, capital market, and you have the money market. Now, what's the difference? If you remember, I had mentioned that when it comes to financial market, what is being offered are the securities, okay, the contracts, okay, what again referred to as the financial assets or the financial securities, okay. Now, the key distinction between these two is what type of financial asset is the company, the deficit unit asking for, okay? What is going to be the life, okay? That's a better term to use, okay? So the key distinction is about the maturity, what we're going to call the life of that particular security. Give me a second. So the key distinction is simply on the security. What's the life of this financial instrument? What is the life of this contract we are dealing with? Okay, is it 1 year or more than 1 year? Okay, is it 3 months? Is it 5 months? Okay, because generally, okay, let me make this better here. So I can have a space. So money market. Okay, so in the case of capital market, I see that what distinguishes for this classification of the capital market and the money market is more towards what is the life, what is the maturity of that financial instrument. Okay, by maturity, what I mean is that if don't forget here you have the debt students and you have the borrower. Okay, and you'll see that they're going to be entering into contracts. Okay, now we can see what is the length of that contract. Is it 1 year, 3 months, 6 months? Okay, if the life of that contract, in this case, the maturity of the security is more than 1 financial year, then we see the contract is, or the transaction is occurring in the capital market section. So here you can see therefore the life is greater than 1 year. Okay, the security, the maturity is greater than 1 financial year. Now, if the contract, okay, they've entered into, okay, or the security has a maturity of not exceeding 1 year, okay, its maximum life is 1 year, then you see the transaction is carrying in the money market section. Okay, we have here life is equal to or less than 1 financial year. Okay, so generally we know that money market is the market for short-term lending and borrowing, as well as the issue of the short-term, okay, securities. Okay, they call the money market section of the financial market. Okay, it's simply what is the maturity of the financial instrument, financial security that is being offered in this particular market. Okay.
Excuse me, sir.
Sure.
Could you please repeat what you said after if maturity exceeds more than 1 year? I couldn't hear you.
Okay. So in case we're going to have the financial instrument, the contract is going to have a period exceeding 1 financial year. Okay. Don't forget you see that these particular instruments are going to be offered, for example, at the floor of the NSE. Okay. So generally, therefore, we do say that the transaction is occurring in the capital market. Okay. The transaction is occurring in the capital market section of the financial market. If, however, the contract, the security, the financial instrument we are dealing with here has a life not exceeding 1 financial year, then we say the transaction is occurring in the money market. Okay, as well as we can have a further definition and say that it also includes the short-term lending and borrowing of money. Okay, but generally the key difference between the money market and the capital market section of the financial market.
Thank you.
Okay, great. Okay, so that's all the key distinction. Okay, and by the way, be asked what the difference. Okay, I think you see some of the question the examiner asking. Okay, what the difference between the money market and the capital market. Anyway, so the instruments that can be issued here, or the contracts in quotes, okay, that can be issued here. One of them is equity share. Okay, I think I've mentioned the case of Safaricom. I gave here equity shares. So equity shares are one of the key, the major component actually of the capital market instruments. Equity share. Okay, don't forget equity shares. They don't have an end life. Okay, as per se. Of course, the life will come from it in case the company is closing down. But either way, equity share they don't have an end life. Okay, that's it. So therefore, they are capital market instruments. Okay, what are the examples by the way of financial instrument that has a life exceed 1 financial year?
Debentures.
Debentures, yes, thank you. We have debentures here. Okay, we have debentures. Okay, debentures being on okay for the so-called the unsecured bond. Okay, the simple term we call it is the unsecured bond. Okay, another example. Of course, bond themselves. the bonds themselves, okay, the bonds themselves are unsecured. The bonds themselves are secured, okay. Okay, the key difference between the unsecured and secured is simply the unsecured bond, okay, so referred to as the debenture. But the bonds themselves, okay, for example, corporate bonds as well as treasury bonds. So you can say this includes both the corporate bonds as well as the treasury bonds. Okay, they form part and parcel of the capital market instruments. Okay, now the bonds, don't forget, they are debt securities. Okay, that grants the holder the right to the receipt of the interest as well as the final repayment of the initial capital at agreed upon time period. Okay, so don't forget, in most cases there will be in quote the redemption, quote the return of capital that you had invested in that particular company. So in case you bought bonds of the government, for example, worth 100,000, don't forget, what is the government telling you that if the life of this bond is 10 years, then in year 2030, you're going to refund back your money. You did pay us 100,000. You did give us 100,000. So we're going to give you back 100,000 plus the interest that bond is going to be bearing for you from today all the way to the year 2030 for the next 10 years, for example. Okay, that's going to be there for a bond. Okay, it's not a loan as per se. Okay, but it is a tradable instrument. Okay, don't forget, loans are not tradable. Okay, then of course we have another example. Could be let me take for example, because I know you know these things, not that it is something new you're finding here. Collins.
Yes, sir.
Yes, another example.
Treasury bills.
Don't forget, for bills, don't forget their life is less than 1 year. Okay, so generally, therefore, they are part of more of money markets. Okay, I'll give you an example. Let me just put it here because you've already given it. The use of the treasury bills. Okay, so don't forget their life does not go beyond 1 financial year. So they are classified as part of the money market instruments. Okay, thank you for that. Nafisa.
Yes.
Okay, another example for the case of the capital market, the instruments that have life of more than 1 year.
I can't think of any.
Okay, don't worry. Don't forget also the case of preference shares. I think you have mentioned that before. You've covered it somewhere along the way. The use of preference shares. Okay, they are also part and parcel of the capital market instruments. Okay. In the case of the money market, okay, the money market instruments, okay, we have one example. The Collins has given us the use of the treasury bills. Okay, now these are issued by the government. Treasury means they are issued or they are even supported by the government. That's what the term treasury implies there. Okay, but these are bills that are issued by the government with the life of, what's the average life for bills? No one is going to ask you this, but of course, definitely in practice, you see them. What's the life of the bills generally in case of Kenya? Brian?
6 months.
Sorry?
6 months.
They're normally in days.
90 days and 182 days.
191 day, 182, and generally 364. You may have 274, can't remember exactly. But generally, those are the life of most of the bills. 91 days, 182 days, and 364 days. Okay, that's generally the life of the bills. Okay. Anyway, use another example. Yeah, for example, don't forget for the government, you have said they do issue treasury bills. Okay, in case you are a company, what do you issue? You issue called a commercial paper. Okay, it's just like a bill. Okay, but only that the difference here is that who is issuing one. Okay, if it's issued by a commercial company, a PLC, then it is referred to as a commercial paper. Okay, referred to as a commercial paper. Bills are issued by the government. Okay, but either way, similar features, only the issuer, we have the difference here. Okay. We can also have the case of what we call repurchase agreement, some money market instruments, repurchase agreement. Now, in the case of repurchase agreement, what happens is that you're going to be having the holder of the asset, the owner of the asset. Okay, let me explain. It here. We'll call it a purchase agreement. Okay, so we have in here we'll call an owner of the asset. Okay, he decides to make a sale of that particular asset. So this is a sale. Okay, to party B. We'll call this party B. Then immediately making the sale. Okay. At the same time, upon making the sale, they enter into a contract with party B. Okay, contract with party B that, hey, in 3 months' time, okay, for example, the sale was worth, let's say, $10,000. In 3 months' time, I'll buy back, okay, I'll buy back that asset from you. So in T3, I'm going to buy back that asset, for example, for $11,000. Okay. Now, what is this agreement like? Okay, don't forget what the owner, the original owner, in quotes, okay, has decided to do is to make a sale and enter into an agreement to buy back the asset, repurchase the asset back at some point in the future. Okay, let's say repurchase the asset at some point in the future. Okay, they'll call a repurchase agreement. Okay, if anything, that's the form of it. Okay, and that's referred to as a repurchase agreement. Okay. However, the reality is that this sale they made here, okay, is actually a loan. This is a loan the company have received from party B, okay, and they're using this asset, this sale, the asset is being transferred. They're using the asset as the security, as the collateral against that loan, okay. That referred to as a repurchase agreement, okay. Now, get party B, his earnings within those 3 months B. Don't forget they gave the owner, okay, 10,000. However, they got back 11,000. So you can see, therefore, the $1,000 here, the difference is like the interest they have earned on the transaction. Okay, the interest they have earned on the transaction. Okay, and the 10,000 was the loan that they gave to the original owner of the assets. That's a repurchase agreement. Okay, I'll make a sale to you, give you money. At some point in the future, I'll buy back the asset from you at a certain price. Okay, that referred to as a repurchase agreement. Clear?
Sir,
Mm,
what if the repurchase agreement exceeds 1 year?
Generally, it doesn't exceed 1 year. Generally, it doesn't exceed 1 year. Okay, if it exceeds 1 year, then it can be a lease agreement. It's a sale and a lease back. You remember those transactions? I think you've done this in financial accounting. The sale and lease back. The finances, operating lease, and a sale and a lease back. You remember? I think you've done them. But generally, this doesn't exceed 1 year. Okay, for the case of repurchase agreement. If it does, then that's more of a lease contract. We'll call a sale and a lease back transaction.
Okay.
Clear?
Yeah.
Okay. So that's on the case of repurchase agreement. Okay, the case of repurchase agreement. Okay, yes, we're here. Okay, another example could be what we call the certificate of deposit, or call mostly referred to as a CD, certificate of deposit. Okay, now what is a CD, certificate of deposit? Okay, now this is like a normal deposit. Okay, we as Equity Bank, we are going to be in court be selling our deposits. Okay, deposit with us, let's say. Okay, so we have, for example, here Equity Bank. Okay, so we can say that we're going to sell, okay, certificate of deposits, okay, for let's say $10,000. Okay, however, within the maturity of this particular CD is going to be in 3 months' time. Okay, so you're going, in short, be repaying you back your money back in 3 months' time for let's say, for instance, 10,500. Okay, that's an agreement you have with, for example, Equity Bank. Okay, so deposit with us X amount of money. Okay, and you're going to this particular contract or this particular loan or this particular certificate of deposit you are made with us is going to mature in 3 months' time, and we pay you back 10,500. Okay, that's, for example, a certificate of deposit. Okay, now if, for example, you as the CD holder, okay, certificate holder, you want to exit the position before the 3 months. Okay, assume that this is also 3 months, and at the end of the second month, you want to exit your position. You want to make a sale. It can happen in the market. Just simply go to the market. I have an agreement, I have a certificate of deposit with Equity Bank maturing in 1 month time. Okay, these are the what you'll be receiving if you are to buy from me. Okay, so I'll be selling to you the particular contract. Okay, today in T2 month 2, for example, for 10,300. Okay, so it is tradable in an open market. So you can be able to trade it in the open market. Okay, referred to as a referred to as a certificate of deposit. Certificate of deposit. Okay. Okay, this is quite straightforward. However, don't forget, before the 3 months are over, you cannot go to Equity Bank, for example, asking for your 10,000. You can't. Okay, it has to wait until it matures. Okay, otherwise, if you want to do an exit, then look for someone else to buy you off from your position. Okay, they call a certificate of deposit. It's another one that is I'm forgetting. Anyway, you have also a case of the case of derivatives, which we shall discuss in for example futures, okay, forwards. So this one we shall discuss this around forwards, options. So a derivative is an asset that derives its value from another asset. Okay, they're called derivatives. Okay, is an asset that derives its value from another asset. Okay, from what we call an underlying asset. An example, a forward is a contract, for example. Just make a mention. Okay, don't cram at all. Okay, a forward, for example, if, for example, I am maybe a farmer of tea. Okay, I do tea export. I involve in tea exports. Okay, I make a sale on the 10th of or the 5th of October. Okay, tea worth I'm selling to European countries. Okay, for example, for how much? 1 million, 1 million euros. Okay. However, as per the contract I have between myself and the buyers of my tea, is that they don't pay today. Okay, they pay, for example, in 3 months' time. So on 10th of December. Okay, that's when they shall pay me money, and they'll pay me, of course, the 1 million euros we had agreed. But don't forget, I was a tea exporter in Kenya. Okay, my books are not in euros. My books are in Kenyan shilling. So what do? I convert this money into Kenyan shilling. Okay, for example, 1 euro. Okay, 1 euro currently. Okay, could be, for example, at let's say 102. These are shillings at 102. Okay, that means therefore in Kenyan shilling, the value of my export is 102 million Kenyan shilling. Okay, don't forget, I'm not receiving the money today. Okay, if in the month of December, okay, the exchange rate then, okay, will be 98 shillings per euro. Okay, I get 1 million from my customer. I convert Kenyan shilling at 98. Therefore, I get 98 million Kenyan shilling. As you can see here, we've made a loss. Okay, it's what called a loss you have made because you're meant to have received 102, but because of the foreign currency exchange fluctuations, you end up receiving 98. You make a loss of 4 million cash shilling. Okay, so to avoid that, what can you do? You can enter into agreements. Okay, for example, with a bank. Okay, you as tea exporter, you approach the bank. This is the contract I have with my customers in European countries. Okay, I want to to lock in the exchange rate. Okay, I don't want these fluctuations. Okay, I want to avoid that risk. Okay, so you go to the Equity Bank, for example, and say, Equity Bank, this is my contract. What is going to be the rate you'll be giving me in 3 months' time? So Equity Bank tell you we are going to buy the euros at, let's say, 100. Okay, so therefore, since you have the contract today, you report in your books how much? 100 million. Okay, in 3 months' time, once you get the money, you in quote give to the Equity Bank. Then Equity Bank give you the share in how much they give you 100 million as per the contract. Okay, therefore you have been able to hedge on the risk. You have been able to reduce that risk. So because you are getting what you are anticipating. Okay, now this is a forward contract. The contract you enter with the Equity Bank is a forward contract. Is a derivative. It is going to be deriving its value. The contract itself is not the product. It's not the product per se. The main commodity is this 1 million euro. However, it has a value with it. Okay, it has a value. Okay, we call the forward contracts. Okay, and of course it is a product which of course you have to pay for it. Okay, so that's an example of a forward contract. Okay. to see their value actually, okay, the value, it's more, let me give you what we call an option. So that's what I've explained so far was a forward, okay. Option contracts, for example, is something similar. However, you don't lock yourself in to the rate, okay. The same transaction you have agreed upon, but at this point in time, you tell the equity bank, okay, I would want to lock in an interest rate. I would want to lock in for an exchange rate, okay. For example, you agree at 100, okay, 100 per $1 for 100 shillings, okay. However, you can tell the equity bank if there will be better rates to be offered then, okay, in the market, that is the month of December, I would want to, the contract does not bind me, okay. It is not a binding contract on my side, okay. To you as equity bank, it's a binding contract, okay. But to me, the buyer of the contract from you as equity bank, okay, will depend on what will be the rate then. So, if, for example, the month of December, okay, the 10th of December, that is 3 months later, if the rate then will be, for example, 104, then it makes more sense for me to get my 1 million euro, go to the market, I get at 104, therefore I get 104 million cash shilling. Because if I was to go to as per the contract, I'll be getting 100 million. So the market is giving me a better chance. Okay. Therefore, you can say, therefore, what you've been able to make, what can say, like, the value of the contract here is the 4 million you're able to make over and above. If the rate in the market in December will be, let's say, not at 104, but to be at 98, therefore, you got the contract. Because the contract, you'll be getting more money, 100 as opposed to the 98 can sharing you'll be receiving in the market then. Okay, therefore, you can see here the contract will be having a value of 2 million. So this option contract, therefore, is another example of what we call derivative products. Anyway, don't worry so much. We shall discuss them in detail later on, okay, in our last topic. But either way, they are part and parcel of the money market. Okay, as you can see, their life generally, I'm mentioning is months. Okay, their life is going to be months, 2 months, 3 months. Maximum is 12 months. Okay, they don't go beyond 1 year. Okay, and they're also tradable. Don't forget, as I mentioned, they're also tradable. So you can go to the market to trade still be someone. You want to now do an exit, okay, from the contract. Okay, you simply go to the market. If there's a buyer willing to buy from you, you present the contract to them. Okay, I want to sell you off from this option contract I had with Equity Bank. Okay, maturing in 2 months' time, in 1 month time, in some few days' time. Would you want to buy from me? You can do so. Therefore, they're also tradable instrument. Okay, so those are the money market instruments. Okay, okay, the main reason why I'm trying to give you this, because you'll be asked, okay, among the following instruments given, which one is not a money market instrument, or which one is a capital market instrument? So you have to get to know of this instrument. Okay, otherwise they can be quite confusing to you, but you have to get to know of them. Okay, because the examiner is going to present to you, okay, examples of money market instrument. Identify the odd one out. Okay, which one not a money market instrument, for example. Clear? Okay, and that is what we shall be discussing. Maybe just to make a mention, okay, we can further split the financial market into another classification. So let me just put note here. So we can further classify the financial market into two categories. We have what we call the primary market, and we have what we call the secondary market. Now, what's the difference? We have said that in case of financial market, there will be the issue of securities, okay, the capital market securities or the money market securities. But if these securities, whether money market or capital markets, they are being issued for the first time ever. So they're being issued for the first time ever to the market. They're being introduced, okay, or they're being offered for the first time ever. They have never been offered before, okay. Either the company is going public, okay, the company is offering the shares. We have Tuskys example. Okay, Tuskys want to become public company. Okay, like the shares of Tuskys are not tradable in the market, as I say right now. Okay, therefore you can see, therefore, if that was to happen, then those shares are being they'll be traded upon for the first time ever, okay, in the market, okay. Therefore, we see that the transaction that transaction is happening in what we call the primary market, okay. And of course, how does the money flow? Okay, don't forget Tuskys. Okay, this is just an example. Okay, the Tuskys is the one issuing shares. Okay, so there will be flow of money. Okay, first is shares from the Tuskys to the investors. And of course, the investors will have to, in exchange, have to give their cash. Okay, have to give their money. Okay, or funds to the Tuskys, for example. Okay, so the transaction is occurring for the first time ever. Okay, assume this happened in the year 2020. Okay, now don't forget, if in the year 2021, okay, I would want to buy the shares of Tuskys. They're not Tuskys is not offering shares right now. However, if I would want to become a shareholder in Tuskys, what do? I have to go to the market and buy shares that I want. Okay, so I have to go to the floor of NSE and submit a bid. I want to buy shares of Tuskys worth X amount of money. Okay, don't forget, for it that transaction to happen, there must be someone, the investor, willing to dispose of their shares. Okay, so you can have, for example, investor A, and you have investor B. Okay, so investor A was one who bought shares here originally from Tuskys. Okay, he's going to sell the shares to you. So there's a sale, and of course you're going to give the cash to the investor A. So you can see, therefore, in the secondary market, okay, the flow of funds is from an investor to another investor. Okay, that's the case of the secondary market. Primary market is from an investor to the issuer, the company issuing these shares. Okay, the key distinction between the primary market and the secondary market. So here is what we call the subsequent trading. Okay, the subsequent trading of the shares or the instrument here. Okay, this was the first time ever. Okay, that's the key distinction between those two, the primary market and the secondary market. Okay, so that's another way you can classify the financial market. Okay, either the primary market or as a secondary market. Actually, you can also classify the financial market into another classification. This classification. Let's see if you can remember it. Yes, you can have what we call OTC. Okay, and you have what we call exit traded. Now, OTC means over the counter. It means over the counter. Now, over the counter means, therefore, this instrument or this transaction does not need to happen on the floor of the NSE. Okay, NSE is just an example I'm giving you. The Nairobi Security Exchange. So you don't have to go to the floor of NSE for the transaction to happen. Like the example I've explained here for options and the forward here. Okay, these two. You don't need to go to the floor of NSE, okay, to enter this contract. All you need, for example, is go, you as the tea exporter, you approach Equity Bank. You don't, or either a bank for sure, okay? You don't need to go to the floor of the Nairobi Security Exchange for the contract to happen, okay? Therefore, it's occurring over the counter. It's outside of, okay, the counter. Counter means the, don't forget, in the early days, it used to be physical counter. Even now, even nowadays, okay? Physical counters where you as the buyer of shares, you submit your bid. I want to buy shares of Safaricom. You as the seller, I want to sell my shares of Safaricom. Okay, so the transfer offer literally in the old days, literally over the counter. Okay, they used to be on the counter, not over the counter, on the counter. Okay, but over the counter means it's outside of that exchange. Okay, it's outside of the floor of the NSE. Okay, they are occurring in the banks. Okay, which means therefore the instrument here that have been traded here, okay, they can't be traded, okay, because they have not been offered on the floor of the NSE, okay, therefore they are non-tradable, okay. So you cannot go to the market and decide to sell off your forward contract, okay, unless you get someone else who is willing to buy you out of the contract, okay, because it was not offered on the floor, on the counter, okay. Now on the exchange, okay, now this is occurring on the counter itself. They're called the exchange, okay, the Nairobi Security Exchange, okay. So if the transaction will have to occur on the floor of the NSE, okay. So here, for example, we can have the case of forward being on the example. You can also have the case of the shares must occur on the exchange itself. Bonds has to occur there, okay. An example of a forward that occurs on the exchange is called a future, but just like a forward. Okay, this is also derivative, but it occurs through the exchange. Okay, so that kind of way you can try to make a distinction between the market OTC or exchange traded instruments. Anyway, that was more towards an introduction towards this topic. Okay, always clear. Any question, don't forget, do not hesitate to ask. Okay. Let's go back to our notes, okay, because that was simply to take you through what the topic will involve. Okay, as I mentioned, don't forget we have what we call financial market and we have financial institutions or financial intermediary, okay, and as we mentioned, the key difference is simply where does the flow of funds occur? Is it from surplus to the next straight away? If that's the transaction, or in case there be a need for an intermediary, then we say that this institution upon which it is occurring is called a financial institution or a financial intermediary. And those are examples which I think you have already given. Okay, take a minute to go through it. Now, what is the key role of those financial institutions? Okay, I think you already know this, but just to put it into context. Of course, don't forget the case of banks. They provide a chance to the savers, okay, a chance for you to save their money. Okay, if you have to assume that there was no bank, okay, there's an economy with no bank, okay, now how would people be able to save? Okay, you do go back, for example, to the informal institutions, okay, to the chamas, all those. But even to make it worse, okay, situation where people hide their money or put their money in mattresses. Okay, don't forget, essentially having banks, okay, they do provide a chance to savers, okay, to be able to earn, to save their money, of course, secure their money, at the same time to earn some interest on that money. Okay. And of course, it will give you a chance to the lenders, okay, to the borrowers, okay, to be able to borrow money from those financial institutions, okay. Of course, in case there's no bank, then of course most of the transactions that do happen, okay, they won't occur, okay. So definitely, it's worth enough that you do take into account that the banks themselves, of course, they have their own problem. That one is for sure, but of course, they do play a very good role in the economy, okay. Then you have the element of risk reduction. Okay, what that means is that if you are to put that money in, let's say, in the mattress the old way, okay, what happens in case that house burns down? It goes down with the money also. Okay, the risk is quite high. But in case maybe it was in the side of, it was you did or you have already did saved in the bank, it doesn't matter whether that bank is there's some thief that comes and breaks into that bank. It doesn't matter. Okay, this is the risk of the bank to assume, not you as the saver. Okay, don't forget, in case the would come to your house and you have that money, that's your loss. You have to bear it 100%. Okay. However, in the case of the bank, it's the bank to bear those losses, not you as the saver. Not you as the depositor. Okay, that's mean by risk reduction. And of course, definitely by putting funds together, it makes it easy to make investment, okay, in areas where it will be hard for an individual investor to do that, okay, or even be able to invest in more wide range of products, okay. For example, mutual funds, okay, don't forget, as we had mentioned, they give the chance to investor to invest their money in some securities, okay. You go to Old Mutual, you want to invest your money, okay, they promise you that every year we shall be giving you a 10% return on the amount you shall be investing with us, okay, sounded good, definitely, okay. However, if, for example, there were some treasury bills, okay, like bonds, you don't want to buy from the government normally gives what called a minimum, okay, that you must buy bonds worth a minimum of, for example, 50,000 or 100,000. If you have, let's say, 80,000 and the minimum was 100,000, then what does it mean? As an individual investor, you cannot buy that bond. Why? Because the minimum is 100. What do I have? I have 80. Okay, so therefore, I have been locked out of that opportunity. However, if you have to invest through the Old Mutual, okay, the case of mutual funds, okay, now what happened? No, you're not the only investor. There are many other investors who don't want to buy the bonds of the government. So that it is able to pull the funds together from all the different investors, okay? And now you as a group, okay, you can be able to buy those bonds that are being issued by the market, which individually you cannot have been able to do, Okay, but by putting those funds together, it becomes easy to have the in quote and group investing in those potential securities which individually you could not be able to invest. Okay. And of course, there's a provide called transformation of maturity. Okay. Just for you an example. Don't forget the bank. They do take deposits for days, okay, or even hours, by the way, okay. They have deposits for among the bank themselves, okay. Either way, if the bank was take a deposit where the depositor will be in quote withdrawing the money at the end of the financial year, that's 1 year. Now, what does it mean? It means, therefore, the bank must prepare itself that these funds we have been given by this saver, by this depositor for 1 year, we should let that money either way, okay? However, the person who's going to borrow that money, okay, how long they want to borrow? They want to borrow this money for 3 years. Now, what do? We have a saver wanting to invest for 1 year. We have a deposit. We have a borrower who wants to borrow for 3 years. If there was no bank, then that transaction cannot happen. It cannot occur. Why? Because the saver is 1 month. The saver is 1 year. Okay. The borrower won't borrow 3 years. So therefore, therefore they have a key difference between how they want to transact. Okay. So this can't happen in the normal situation. However, don't forget the bank. In the case of the bank, that can happen. Okay, why? How can that happen? Don't forget the bank. You're not the only depositor. If anything, okay, you're not the only depositor. There are other depositors. Okay, so the bank can therefore be able to transform your 1 year deposit into a 3 year loan. How? Okay, if at the year 1 we have the two of you coming to save to borrow. Okay, assume the same amount of money. Okay, the money goes to this depositor, goes to this borrower. Okay. At the end of the year, the bank could take money from quote other depositors, pay you off. Okay. So at the end of, if those deposits will be 1 year, at the end of the second year, the same thing happen. Okay. Other depositors have made their deposit in the bank. So what happened? The bank takes that money and pay you off you as the depositor for the second year. The third year, the same thing. At the end of that year, the borrower, in quotes, returns back the money to the company, to the bank. Okay, so a 1 year deposit has been converted into a 3 year loan. By transformation of the maturity. Okay, I hope that that has helped. And let me check through the use of a graphic. Yes, we'll start that transformation. Okay, we see that you have here 1 year deposit. And you have, we want to convert that into a 3 year loan. Okay, here we have 0, year 1, year 2, year 3. Okay. Okay, this is year 1, year 2, this is year 3. Don't forget the deposits. Okay, again for 1 year. However, we want to borrow for 3 years. Okay. Don't forget, as I've mentioned, you're going to have here the deposit 1 million. The bank yearly pays back 1 million. However, don't forget already they have 1 million they've received from other depositors. Okay, so you mean where you are. End of year 1, end of year 2, same thing happened. Pay back 1 million to the depositors. Then they already have received other money from the borrower, from other depositors. Okay, that year happened. Okay, you as the borrower here, you took 1 million. Okay, you took 1 million from the bank, but now you give back the bank 1 million. And the bank is about not to repay the other borrowers. Therefore, our 1 year deposit we had here has been transformed into a 3 year loan. The transformation of the maturity. So this can only happen in case we are dealing with a financial institution or a financial intermediary. Clear? Afra? Afra? Hey, Afra, are you in class or not? Okay, so that's some of the functions that a financial institution normally the role they normally play in the economy. Okay, of course we have more than this. Those are some of the key things they do, or some key functions they do play within the economy. Okay. We went ahead and say that at the end of the day, we can make that distinction between the financial market, classify them in two categories. We have the money market and you have the capital markets, and the distinction simply is on the life of the instrument. Okay, what's the life of the instrument? 1 year or less than 1 year. If it's 1 year, then the transaction is occurring in the capital market. If it is more than 1 year, the transaction is less than it's equal to and less than 1 financial year, then we say the transaction is occurring in the money market. Okay, the key distinction between those two. Okay, so that's a key difference between the capital market and the money market. The money market, as I had mentioned, okay, this where the trading of the short-term securities, okay, as well as lending and borrowing on a short-term basis. Okay, so we see that the transactions are occurring in the money markets. Okay, the common participants will be the bank and as well as other financial institutions. Okay, so they want to that facilitates. Okay, as well as they are also the major parties actually. Okay, of this transaction. Okay, of the money markets. Okay, they include they mentioned T-bills, commercial paper, deposit agreement, certificate of deposits. Okay, so all those examples of the money markets. Okay. Go through it if you want. Okay, I hope it's clear. Any question on this? Yes, Elvin.
Where does the banker's acceptance fall and how does it work?
Thank you. Okay, that was the instrument I was looking for, the banker's acceptance. Now, in the case of banker's acceptance, actually, there's a common term that is normally used on the field. How is the term used? It will come, okay? Now, in the case of banker's acceptance, let me give an example. So I think to explain through an example, it's better. So bank acceptance generally, okay, it's a money market instrument, okay? It's going to be a money market instrument. What happens, let me give you an example here, a Chinese company, okay? With the China company, and here you have a Kenyan company. Now, Chinese company want to make a sale of goods to the Kenyan company, okay? The trading is on credit, okay? So this is going to be a trading. However, the trading is on credit, okay? Now, this company, the two of them, the Chinese company, Kenyan company, they have never been involved in trading, so they are not so sure. Hey, I might give you goods on credit, then you fail to pay me, okay? However, you want to do the trade, okay? What happened? Like, as a Chinese company, I would ask you as a Kenyan company, you want to buy goods from me, go to your bank, okay? Get your bank to agree that in 3 months' time, they'll pay me my money, okay? So what happened? The Kenyan company goes to, let's say, Equity Bank, okay? And ask the Equity Bank, okay? We have here a supplier in China who don't want you to accept liability, okay? That hey, in 3 months' time, I'll pay them, okay? So you being my bank, why don't you write to them a letter, okay? Because it's you, Equity Bank here, and let's say we have HSBC, okay, bank in China, like through the bank of my Chinese supplier, that in 3 months' time I'll pay them. Okay, I'll pay them my money. So therefore, the two banks communicate through letters. Okay, so the company, HSBC company, writes to the supplier that hey, the bank in Kenya is willing, okay, that it's giving a guarantee. Okay, it's giving a guarantee in 3 months' time. It will pay you. The Kenyan supplier will give you money. Will pay the money. Okay. So since there's a guarantee, then of course you as Chinese supplier, of course you're going to be, the risk is a bit reduced. Okay, is reduced, not even a bit. The risk is reduced because the two banks have done the communication. Okay, what Equity Bank is saying is that I accept liability if the Kenyan supplier fails to pay the money. The Kenyan customer fails to pay the money. Okay, so he's accepting. It's like a bond called a banker's acceptance. Okay, is accepting the liabilities that in 3 months' time I agree. All right. If my customer, okay, if the Kenyan customer fails to pay your money as a Chinese company, I'll pay the money. Okay, is accepting liabilities, is accepting the responsibility. Okay. So as a Chinese company, once you receive this letter of acceptance, okay, what you can do is that you may not want to wait until month 3. Okay. So if, for example, the goods you sold to the China company was $1 million, okay, you can decide instead of me waiting until month 3, why don't I just go to the market and sell off this acceptance? Okay, I sell it for example, $990. Okay, I don't want to wait until month 3. I just go to the market, dispose of the contract for $990. But don't forget, once you make the disposal, any payment from the supplier will go to the person you have sold to. Okay, in short. Okay, therefore you're willing to take in quote a loss of $10,000. Okay, and instead of waiting until the end of month 3. So this contract, we'll call the banker's acceptance, is actually a tradable instrument. Okay, it's actually a tradable instrument on the Chinese company here. Okay, we'll call actually banker's is a money market instrument. Okay. Yeah, that's another example of the money market instrument. That is what I was actually forgetting. Okay, I hope it's clear. Don't know who had asked that question.
Yes, it is.
Okay, great. Okay, so it's one of the example of the money market instrument. Thank you for bringing it up. Okay.
Excuse me, sir.
Yes, someone was asking a question.
You said the banker's acceptance can be tradable. The bank can sell it or the company.
So don't forget this acceptance, this letter that was sent from Equity Bank to the HSBC. Okay, no, the banks are not the one trading on it. So the bank for the Chinese company, I give example of HSBC. Okay, what is going to happen is that they're going to present this letter to this supplier in China. You can go ahead and supply the good to this customer. The bank in Kenya is willing to accept the liabilities. So don't worry, the money will come to you. Okay. So which means therefore, the letter with the person who having the letter can go ahead and decide, I don't want to wait until month 3. Why don't I just get the money today? So they can go ahead and actually make a disposal of that contract. So they're the one who can trade on it, okay? The Chinese company, they're the one now who can be able to trade on that particular letter. I hope that was your question.
Yes.
Okay, great.
Thank you.
Okay, welcome. For the case of the capital markets, okay, I think we mentioned, okay, there's going to be where the trading of the long term, okay, or securities with the life of more than one financial year will be occurring, okay. So in case of equity, preference shares, bonds, what is, I think we mentioned a number of them, okay. That's where the transaction do occur, okay. We can go ahead and split the market into primary market and secondary market, okay, which I think we already mentioned. Primary market, the instrument is being issued for the first time ever. Secondary market, we have the trading of the instrument subsequently occur after the first issue. Okay, can take a minute, go through it. So what does, or how does the secondary market help in maybe the growth of the economy? What is their main role, you can say, when it comes to the secondary market? Okay, don't forget, if a market exists and there's no secondary market, okay, then how will even the primary market exist? Okay, primary market is where there'll be issue of the first time, okay, instrument, the main issue for the first time. Maybe it can exist, but of course they supplement each other. Don't forget, because if the primary market, there's no issue of instrument in the market, then how will the secondary market exist? Okay, it also, we all be having the trading of the old shares. Okay, so the private market in a way supplements. Okay, supplements the secondary market. Okay, because they work hand in hand either way. Because in case secondary market is not active, okay, then of course private market will not be active as well. Okay, if the shares currently are not doing well, then if you don't want your shares in the market, then of course quite unlikely you find people willing to buy your shares. Okay, so don't forget the two of them goes hand in hand. Either way, so the market provides a chance for investors to diversify their investment, their portfolio. Okay, what do you mean by that is that if, for instance, you bought bonds, you bought equity shares, okay, you bought shares of Safaricom when you're still young, okay, we see that normally see that actually that equity shares are more expensive, okay, they're more risky, not expensive, they're more risky than investment in bonds, okay. So if, for example, you did take a high risk investment when you're still young, okay, and now you are 70, you may want to look, hey, maybe my investment I made when I was 30, when I was 20, may not be the most suitable investment right now. Why? Because right now all I need is money to, I don't know, you keep you going. Okay, so you need an investment that is going to be guaranteeing you returns. Okay, not a risky asset. Okay, if there's no secondary market, how can you dispose of those shares you bought 40 years ago? You can't. Okay, so you're given a chance of diversifying. Okay, well, the best way is to look at risk shifting. Okay, more whatever it was I'm trying to explain is more towards risk shifting. That you can be able to change your risk of your assets, your portfolio, your investment from a high risk portfolio to a low risk portfolio, for example, or even vice versa. Okay, that can only happen if we do have an active secondary market. Okay, towards the diversification, okay, it is possible for you to be able to invest in a wide array of securities. Okay, for instance, if you want to, or rather, the secondary market, okay, offers you the chance to be able to invest in a number of asset securities. Okay, if, for example, you begin off by buying shares of, let's say, Safaricom when they're being issued, as soon as it's being issued today, 2020. Okay, with time, you may want to increase the risk, okay, by buying more securities, or reducing the risk, okay, by trying to increase more of bonds in your portfolio, okay, or call rebalancing your investment, okay. You may decide that, hey, I would want to invest in real estate, okay. What do? You buy shares of, it's called Africa Watch. Anyway, there's a company involved in real estate that is listed in the NSE. Okay, so either way, you can be able to either increase your asset base in your portfolio, or decrease, okay, the number of assets you have in your investment. Okay, that can only happen if there's an active secondary market. Okay. Now, hedging, I think I did mention along the way when we're discussing the options, the forward, and the futures. Okay, and you see that the market offers the chance, okay, to reduce your risk or even to hedge your risk. Okay, for example, if you're an exporter, just repeat what I had mentioned. You can now be able to sell off or to make a sale. Okay, and you hedge the risk. Okay, by buying either forward contract, a futures contract, or even an option contract. Okay, someone else is going to be, in quote, be willing to bear your risk. Okay, that happens in case we do have an active secondary market. Okay, arbitrage is a chance for you to earn what we call profit with no risk. Okay, what we call the riskless profit. Okay, being able to earn profit without risk. Okay, for example, if you can assume that you have, okay, assume that can happen. You have a buyer, you know, a buyer who's willing to buy shares of Safaricom at 20, at that's 2. Okay, currently they go for 27.5. Okay, if that can happen, you have a buyer willing to buy the shares at 32, and the current price, the market is 27. You don't need to invest anything. All you trades is go to the market, look for potential sellers. Okay, that hey, you want to make a sale, at how much? 27.5. Enter in a contract with them. Okay, that hey, I'll buy your shares. Okay, at 27.5. Okay, enter another contract to their side. Okay, the buyer, I'll sell to you shares at that 2. Okay, so once you have the 2 contract, you have made your gain. Don't forget. Okay, because you're going to make a sale. Then once you receive the money from the other party, you pay this other party. Don't forget your initial investment in this transaction is 0. Okay, because you didn't invest anything. All you needed is to get 2 participants. Okay, or what we call a market mispricing, which you're able to utilize. Okay, earning what we call a riskless profit. Okay. Rarely does it happen. It can happen, but rarely does it happen. But either way, this can happen. Okay, but that can only happen if we have a secondary market. Okay, for you to be able to earn or call an arbitrage profit without incurring any risk. Okay, it's actually referred to as the riskless profit. Okay, okay. Okay, that will happen in case we do have a secondary market.